Good evening, ladies and gentlemen. Thanks for joining me today. I will be your host for our Forecast 2020 event. My name is Trevor Wilde. I am the CEO of Wilde Wealth Management Group. I'm also the co-founder and an advisor here with Wilde Wealth Management Group. And this is an exciting event that we normally get to do in person. The last one we did was actually February of 2020, right before COVID hit and the world shut down. So thank you for being here tonight. Many of you have attended this event. This is an event that we've been doing for close to 17 years. I'm sorry we can't be experiencing this together and visiting. I can tell you firsthand, it's a lot more fun for myself and for my partners that like to present to be doing this face-to-face. But for now, in this COVID world, this will have to do. So we hope you enjoy the contents, and we hope that you and your family are safe and healthy. To give you a little bit of background of this event, so this forecast event, as I mentioned, is an event that we've done now for about 17 years. And the purpose of this event is to look back at the year before and look at economic conditions, the market, all the things that we went through. We've got plenty to talk about as it pertains to 2020. And then we take a little look at, okay, where are we now and what should we be focusing and watching as we move forward? We also like to have a little bit of fun, so we like to poll the so-called financial experts or pundits that like to make predictions about the market. So we're going to highlight a handful of experts that have predicted what they believe the markets are going to do this year. And then as a follow-up to this event, we do an event every year that we call our halftime report. Our halftime report is typically held in August. We collect data through the first half of the year and put together a presentation. But we always like to pick on those pundits because it's very common that they were not right. And part of the purpose of that is to have a little bit of fun as well. So as we normally do, I want to start here. Let me make sure things working. I want to start by introducing a few people by virtual way of meeting people now. And again, this took a whole new meaning this year. When we used to do this event in person, it was kind of fun to say, a lot of our support staff, the people that really run our business and help you on a day-to-day basis, that they don't always attend these meetings, and people, in a lot of cases, never met them. So we like to give you a chance to meet them kind of by way of picture and name. Man, that's taken a whole new meaning when we think about how life is like right now, where we haven't had many in-person meetings really since March. The vast majority of our reviews are being done over the phone or via Zoom. We are meeting people like we never have before, and again, in a virtual format. I can tell you, I've been doing this for 21 years. I don't think prior to this year, I ever, maybe once or twice, had a new client, somebody who was introduced to us that became a client that I never sat down and shook their hand. And I can tell you, in this world with Zoom, that is the common place. And I think we're all adapting and getting used to that. But before we get into the meat and potatoes, I do want to take just a second to introduce you to a few folks on our team. We've got our advisor group up on the screen right now by location. So for some of you who have been clients for 20 or 30 years, you know that we've added locations as we've grown here especially the last 5 or 6 years. So what we've done today is we put the advisors up by location. So these are our advisors who call our Scottsdale office their primary office. And yes, for those of you who know my dad, who is also my co-partner and founder of Wilde Wealth Management Group, he still has a corner office and he's still very active in the business. And again, many of you have been introduced to us by some of these great advisors that we brought on or have joined us as partners over the last few years. And we're excited to have you and excited to have you here listening to us. Our office in Tempe, Glendale, and Payson. I actually had a client that gave me a call and said, hey, I was driving up north because we needed to get out of town. I didn't realize you had an office up in Payson. And we do. We have an office right off of Main Street in Payson. And if you're ever up in that neighborhood and want to say hello, please feel free to stop by. More important than the advisors, these are all the amazing people that really make the day-to-day operation work. These people that are up on the screen right now are our client service teams who help support everything that we do, from changing addresses to resetting passwords to helping you track down 1099s and tax forms, which we're getting ready to come into that time of year. So I do want to say a special thank you to all the people on this screen. We are blessed to have an amazing group of talented people that support us and you every single day. And I can tell you, going through COVID and what the changes in our work life, which we're going to talk a little bit about today, I am so proud of our team. We had so many people step up and offer to help in ways that we've never seen before. And just like you and your families, many of our employees have kids at home that are now working from home, learning from home, trying to be entertained at home, all those things that have changed. And I am just incredibly thankful and proud of the team that we have here. So this will give you a chance to put a name to a face, maybe if you haven't seen them before, and also say thank you. One thing that we also like to do is just talk about some of the things that we're involved with as a community. I was raised in a family that was very community minded. We always gave back. We always, not only in the form of labor, but also financial help when we could. And so we had a great year in retrospect. We were ranked #1 by Barron's in the state of Arizona for 2020. That was released in March. That was the highest ranking that we've ever had. We've been lucky enough or blessed to be recognized by Barron's for 12 years in a row. Last year was the highest ranking at #1. We do a lot of community outreach and fundraising. And again, thank you, because many of you have participated in these events over the years. And we're going to talk a little bit about what happened in America with charitable giving. But as you'll find up here on the screen, we were very active in 2020. Our Toys for Tots donation, although it wasn't as big as previous years because we had to cancel our Zoo Light celebration, was a tremendous success. We donated over 300 toys and about $5,000 in cash. We're currently running right now in the first quarter of 2021 a brown bag program, which the Arizona Brown Bag Foundation is a nonprofit organization that helps deliver food primarily to elderly people in the Scottsdale, North Scottsdale area that cannot go out and get it. And when we think about this pandemic and who's impacted, there's all of us are impacted at one extent or another, but there's our elderly population, in particular ones that don't have family, have physical or mental ailments, really need our help. I want to say thank you. We're gathering food right now, and our conference room is really piling up. So I think it's going to be a very successful program. If you'd like to help contribute to that, because we are running this program through the end of the first quarter, please let us know, and we'll get you the information. We were also voted by the Phoenix Business Journal as the 15th. We were ranked 15th by the Arizona Business Journal for best places to work in our category. And we had a year where we brought on some really great, talented people. Several advisors joined us this year. Ben Zamora, who came from Wells Fargo. Mike Self, who recently joined us from another local independent firm. And some really great, talented people. Joanne, Colleen, Zaina, all joined us this year in 2020. And we'll love to have you help us welcome to the firm. When we think about what's happening this year, we have a handful of initiatives that we're excited to be presenting to you. We have an educational series that we launched last month where we have a different general topic, and we'll be doing a virtual learning that will be distributed to all of our clients. We have a new podcast that we're calling The Wild Wealth Way, which also we launched in January, webinar Wednesdays, which again is that educational forum that I missed. We're doing a quarterly conference call, which we just hosted last week with generally someone from the industry and a lot of fun things that we have in store for 2020. So thank you. We also have a handful of affiliates that are important people on our team. You'll see them up here on the screen. Some of you may be working with these advisors or professionals, and we're just proud to be partners with them. Lastly, before we get into the meats and potatoes of tonight, our business partners are incredibly important partners for us. One of the things that we did 20 years ago that does make us different and unique is we said we want to be in a position where we can help our clients, help serve you with all aspects of your financial life. And what that meant was we needed to bring professionals on that were experts in their fields like tax, fields like estate planning, insurance services, and real estate. And on the screen here, you can see some of our partners who really, all of these gentlemen and teams have been working with us for many years. And if you didn't know that we offer these services, then now you know. And if we can help you in any of these areas, please let us know, and we'll get you connected to whichever partner it is that's in your specialty that you might be in need. So here we are. We're going to head into the meat and potatoes of the evening. And the format that we're going to go through this afternoon is common to what we've done for 17 years. We like to cover three main areas, and we're going to break it down by where we've been, which primarily the focus is going to be 2020. Where are we now? And for now's purpose, we pulled this information together in early January based on December 31st values. We have an approval process to get through. So right now, looking as we go into 2021, what are the things we're watching? And a little bit more, like I said before, about where we might be going and what we may be experiencing as we get through 2021. Before we get into the serious stuff, we like to have a little bit of fun with you. And if you'll remember, if you've attended events, so we have a quiz. So I'm not going to be too hard on you. You're not going to be graded here, but a little bit of fun. And there was so much uniqueness that came out of 2021. One of the things that we found was Merriam-Webster's Dictionary, word of the year. What do you think the word of the year is? Now, you don't have to say it out loud. Again, we're not grading, just some fun things. You probably guessed this one right. Pandemic was the #1 searched word of the year. And unless prior to 2020, unless you were trying to find a good movie to watch, you probably didn't think much about it. It's on our minds every day now in this world. This was just kind of a fun quote that we found. One exciting thing about being alive at this pivotal moment in history is I'm constantly learning about strong opinions I didn't previously know I had. Emily Gold, an essayist. Virtual school. This was not something that existed prior to 2020. And many of you who might still have kids in school or grandkids in school know the challenges that are happening. It's interesting, our kids are in the Scottsdale School District. We went away for spring break on March 5th and never returned to school. We came back, immediately went to online schooling, went through the summer, came back to school in the fall. We're still online. And really since October, we've been somewhere between virtual learning and in-person learning. We thought this was a little bit funny. Da Vinci is no longer Da Vinci. It's a new meme called Da Vinci. I don't know if you've heard it. I have never heard about this. But the emoji, I guess, just made a little bit more sense. So Da Vinci is no longer Da Vinci. Da Vinci is Da Vinci. Which of these shows was the most watched in 2020? I can't think of a time. My wife and I, my family, we really are very active people and really don't watch a lot of TV. But I can tell you from March, especially through the beginning part of the summer, we did catch up on quite a few shows and HBO. So here's the question. Which of these shows was the most watched in 2020? Lock and Key, Queen's Gambit, Space Force, or Tiger King? If you guessed it, you probably guessed it right. Tiger King became a little bit of a famous show as we got into 2020 and pretty unique. All right, so enough with the fun. We're going to get into the meat and potatoes now, which is where we've been. We have so much to talk about when we consider and think about what we went through in 2020, but we're really going to start by talking about the economy. And again, there's a lot of places to start and really to get into here. But for the theme of the event tonight, and as we're putting these slides together, we really came up with kind of three primary areas to kind of think about the economy, right? We came into March, March 17th, coronavirus took a hold. The economy was essentially shut down. And if you'll see here on the screen, we've got a picture of a car, and maybe this is you. You're driving your car down the road, and off to the right, you see this big semi truck, and it's carrying thousands and thousands of pounds, in this case, of lumber. We want to use this as we go through tonight's conversation as an analogy to what this is going through. And for just a second, if you'll think about that, if you've ever driven behind a giant 18-wheeler carrying thousands of pounds of goods, when that 18-wheeler comes to a stop, it doesn't just accelerate on the dime, right? Now, some of you out there might have Teslas. I don't have a Tesla, but my friend has a Tesla. I don't know that I've ever driven in a quicker car that can accelerate from 0 to 60 as fast as that electric car can. An 18-wheeler doesn't do that. And that analogy we're going to try to carry through this presentation a little bit, because in a way, that's kind of what happened to the economy, right? We had the best, the lowest jobless claims that we'd had in close to 50 years coming into March of 2020. Economy was hitting on maybe not every cylinder, but it was a very, very strong economy. Our tractor trailer truck, our 18-wheeler, was cruising at a pretty good pace. And we came into March and bam, the economy stopped. Markets were shut down, not stock markets. The economy was shut down. Businesses were closed. Travel was suspended. And we very quickly went from 60 miles an hour to zero in that 18-wheeler truck. And unlike a sports car that can get up and go, the economy doesn't work that way, right? The U.S. economy, if you think about getting from 0 to 60, that takes time. So we're going to talk through some of those things. We put a couple of the big things that occurred, right? Obviously, starting with the pandemic. The pandemic slammed the brakes on the economy, and we went from from 60 to 0 in the matter of seconds. The stock market, which had hit an all-time high at the very end of February, lost somewhere between 30 to 40% of its value from the peak in February till the middle part of March, so about March 17th. It didn't take long, though. The government acted. They fueled the economy with what was known, or what is known now, as the CARES Act. There was a massive stimulus plan that was launched in the middle part of March to help the economy going. And as we said here, trying to smooth the road, low interest rates, the government came in and aggressively cut interest rates and started a quantitative easing program with an attempt to get this big 18-wheeler truck going a little bit. We're going to dive into this just a little bit more. What we have here on the screen is a graph of the real GDP. And if you'll see, this goes all the way back to 2011. And you can see there's waves and valleys. 2011, we saw increase 12. Waves and valleys, but a continual kind of positive pattern. You'll see that sharp drop off to the right of your screen, which was the pandemic, right? We went from having somewhere around 2.5% annualized GDP growth to almost a 10% drop immediately, right? Now, what you'll find on the far right of that slide, as we got really out of the first quarter and second quarter, we saw a lot of that come back. And we saw a lot of the economy almost getting back to flatline by the end of the year. And again, as we already talked about, what you have on the screen here now is new case COVID cases. And the top line, and we don't need to go through all these slides in detail, but that green line was the United States, and we've got it broken down by country. And what we saw was a massive spike, back in May, and then it kind of tapered off here in the United States. We saw another spike in COVID cases in July. We tapered off into September, and then we saw massive spikes as really people came back from Thanksgiving and the weather changed and whatever else caused it. We saw a massive spike. And we didn't see another stimulus plan from March until the end of December. We did see a stimulus plan pass in December, and reopenings became reclosings, right? I mean, we saw it across the country, depending on where you live. Economies reopened. Arizona was a little bit slower to close early on than they closed, and now we're kind of on the opposite end of it, where we're seeing more reopenings come. Employment, monthly employment gains completely stalled. And again, much like that GDP path, you see that chart moving from left to right, which was the last few years. Economic gains were steady. Again, we came into March of 2020 having employment at near or maybe even beyond what optimally could be full employment. You'll see that incredible decline as we went, as the economy shut down in the quarter. We saw reopenings, which you'll see that line kind of came back up. And then we saw another wave in economic shutdowns across the country at the back half of 2020, which again caused monthly employment gains to stall as we saw coming into 2021. A lot of stuff on a lot of these charts, so don't overthink it. But here's another sign of that. What we have here, the dark blue bars are unemployment rates, what's calculated as the unemployment rate. The light blue bar, which we've talked about in previous events like this, are what we call total unemployment. The dark blue lines are people that are filing for unemployment claims. The light blue line are not just those folks, but they're also people who may have exhausted their unemployment benefit. They're still not working, or maybe they're working 2 or 3 jobs to make the same wage. And there's a big difference between those two bars. What you'll see going back to December, again, unemployment was very, very low. Even the true total unemployment number was under 6% coming into 2020. You can see the spike in April as the economy shut down, and you'll see it kind of moderated, and then it started to tilt back up. The bottom line is unemployment remains very, very elevated, but it's not equal. And this slide doesn't really show that, but what we've done here is we've broken down different areas of consumer consumption, right? And you can kind of see the graph at the top left, where the blue bars represent personal total consumption. It's a light green line represents durable goods. The purple line represents non-durable goods and services. What we saw happen, and really what was amazing as we went through this and we saw unemployment spike, consumers continued to spend. But what they did do is they shift the type of spending that they had. For example, if you look at this graph, the red line represents service industry. These are going to be hotels, restaurants, travel, cruise lines, and you'll see that sharp decline did not recover like the green line. The green line is durable goods. These are things that when we were forced to go home, we could still do. We could still order clothes online. We could order things from Amazon. And quite frankly, like many of us sitting at home going, geez, there's a lot of improvements. There's a lot of things I'd like to do around here in my home. A lot of that spending was done in people's homes. Interestingly enough, though, the statistics, they tell us something, but they can also be misleading. And the reason why we put this on here is we do think it's important. There's so much data out there that you all are listening to, whether it's your news or CNBC or the papers you read. Statistics can be misleading. And it's interesting. These are two different graphs. They both cover gross domestic product. The difference between the black line and the light blue line is the light blue line tracks quarter over quarter changes as a percentage to GDP. So what you'll see on the blue line is going back to Q1 of 2020 was a sharp decline, but then there was a significant increase and there hasn't been a decline, right? That Q2, Q3 number is off the chart. What this is tracking is a percentage of increase quarter over quarter. So quarter 3 was significantly better than quarter 2, roughly 7.5%, the same for quarter 4. The black line is actual GDP. And what you'll see there is it tells a very different story. Yes, we've seen a lot of recovery in GDP, but that black line is still not to zero, at least as of the end of the third quarter of 2020. So again, statistics are important, but it's important to understand what you're reading. And again, interesting to see these two statistics and how they line up. Consumer sentiment. One of the things that we always try to talk about as we're reviewing how things are is how is the consumer feeling? And what we found is that over the summer months, the general consumer was actually feeling pretty positive. But what we saw as we got into November was a decline, a pretty dramatic decline in consumers. And here's a quote from Axios Research. People are more stressed about their finances than they've been since the summer months. So we saw stress levels and consumer confidence reports go down as we got into the summer. And then they improved. And if you think about what happened towards the end of the summer, we saw economies reopen. We saw a lot of economies reopen depending on the state you live in and where you're at. Case numbers were coming down. But what did we see coming into September and October? We saw the exact opposite. We saw cases start to go up. We saw closures start to happen. And again, that anxiety that people feel and that confidence went the other direction. As you can see here, 22% of households were concerned about the debt, that their debt was growing. 46% were worried about their job security. 47% worried about paying bills. And 15% people were finding it harder to pay rent or their mortgage. Consumer confidence is important. And it's also, I think, interesting to see when you think about COVID case spikes and closures, how closely they correlate to how people felt. And it's a big, big deal. What about the stock market? We talked about the economy and kind of consumers, but what happened with the stock market? Perplexing. But what happened was, again, back to our analogy of driving that big rig, while the economy, the general economy is that 18-wheel big rig, is still chugging along trying to get back to 60 miles per hour, our Mustang, which in this case was the stock market, zoomed ahead. In history, what we saw, we had ended a 12-year bull market, technically at the end of February. It was the longest bull market in history, and we ended it February of 2020. We saw the shortest recession in history, which only lasted about a quarter and a half. We saw the market drop roughly 40% from the end or middle part of February to the third week of March. And then we saw a market that on its forefront, at least, almost completely recovered within 3 or 4 months. What's interesting, and I'm going to talk a little bit about the S&P 500 as we go, and I've got a slide here that I'm going to skip forward to get to that. But we saw a market that was a sports car. They didn't act the same. And it's interesting, many of you, we have a slide here in just a second that talks about why did that happen. We hear this all the time for our clients. Our clients are looking at unemployment numbers and seeing people that are struggling. They're saying, why is the stock market up? Why are we recovered? It doesn't feel like it should be. We're going to talk about a few of those things. So again, the U.S. stock markets are something to worry about. We do have to worry about the volatility. What we're showing here, there's two different lines on your screen. There's a pink line, which is the VIX index. The VIX index is an index of volatility. It tracks volatility in the market. The black line is the S&P 500. And what you'll see is if you go to the far left of the screen, as we come into 2023 and into March, again, we saw that stock market drop about 40%. The VIX index spiked. A lot of volatility. And again, think back to that period of time. This is the second and third week in March. The government had just made a historic announcement that they're going to force, in states were forcing businesses to close. People were shifting from home. Travel was canceled. Schools were closed. This was, if you have to almost take yourself back there because it feels like so long ago, it was chaos. And what we saw ensuing immediately after was chaos, and chaos in the markets and in the VIX. Now, as we got out of March and into May, we saw a quick recovery by the S&P 500. If you follow it along, the S&P 500 by about November was somewhere back to break even. And what's interesting about that is that it wasn't the same, though, across the board. There were many indexes, and some of those companies that were benefactors of COVID, and they are the companies that they're the companies that benefited from not being able to go out and shop, right? The online retailers, the big technology companies. I can tell you, we're a small business. We employ about 55 people between advisors and staff. We spent more in technology in March and April than we had in probably the 2 previous years combined. We had to buy new programs and new computers. We had to buy laptops so that people could work from home. It was just an incredible amount of an incredible time. But when you think about the stock market, there was those companies that benefited from it, but there were a lot of other companies that are still great companies that didn't. They were on the opposite end of it. They were the retailers that you couldn't order online from, or had a service that you couldn't order through Amazon. So what happened through this whole thing? It was an incredibly bumpy year. And I love this chart. We've shown it before. What this measures on a year-by-year basis is how many days in any given year we had more than the market, the S&P 500 was up or down more than 1%. And we've gone all the way back to 1996. And you can kind of play with this and take a look at the numbers yourself. But in 2020, we had 109 days where the market, the S&P, was either up more than 1% or down more than 1%. If you look back historically, you can count them, in the last 30 years, there's only been a handful of times where that's occurred. It happened in 2008 and 2009, and then coming out of the 2000, 99, 2000, 2001, in those periods of disruption. So we saw a very volatile year, and it was a very bumpy year. Well, what happened is some of these disruptions did lead to attractive returns. As I mentioned before, the leaders, and we've got them up here on the screen from a sector, were those growth companies. When you think about, again, back to what I mentioned earlier, as a company, we spent more money in technology in 2 or 3 months than we did in probably the previous 2 or 3 years. Those companies were the companies you would suspect. They're the big technology companies. They're the big apparel companies. And where we saw on the other end is those value plays, those value companies that probably produce a good or a service that was pre-COVID, pre-pandemic, was more of a standard, were really hurt. And so what we saw last year is you see this big dichotomy of performance depending on what sector and what asset class you're looking at. We also like to call this the vaccine rally. So the previous slide, kind of looked at different sectors. What we looked at here is, well, what happened post-vaccine announcements? So, we didn't get the vaccine announcements until the beginning of November. November 9th was the first vaccine announcement. So we knew that it was being worked on, but everybody was sitting on pins and needles waiting to find out, are we going to see a vaccine? Is it going to be effective, and when could it be here? What we tracked here was we looked at different categories, again, value, core, and growth, knowing that the growth companies were a lot of those big cap technology companies. They were the growth sector, were those areas that benefited from this. Those value areas, which really became out of favor because they didn't benefit from the pandemic, they're on the far left under the value category. And what you can see is since November 9th, when we finally got the vaccine announcements, there's been a pretty dramatic shift and swing pretty quickly in performance, where value, you can see on the far left, is up 12 to 23%, and growth, the stuff that did the best early on, has started to slow, at least in its performance. Now the good news is everything has been up since November, but we do think that this vaccine, and we're going to talk more about this as we get to this conversation, vaccines are important, and they're important to the reopening. And that isn't a statement that everybody should get it. That's a personal opinion. But we do believe that the markets will be watching this very closely, and we're going to be watching that. An interesting quote that we found in the Wall Street Journal: it's finally time to buy back into shares of unloved and cheap stocks. This was written on November 12th, and the point of the matter was the same thing that we just talked about, which was there was all these companies that did incredibly well coming out of the recession in March, April, May, June, and July. Primarily, they were companies that benefited from the pandemic. This statement came on November 12th, 4 days after the vaccine announcements, and essentially saying the same thing, that it's time to start to get back in. What about valuations, right? The stock market's gone crazy, and again, we always like to touch on valuations, and the best way, or the best known method of looking at valuations, is something called the price earnings ratio, or the PE ratio. The PE ratio is intended to be a relatively simple way of understanding at any given time is a stock expensive or cheap based on its earnings. And what you can see here, and this is two different running lines, we have the S&P 500 current price earnings, and that is the light blue line is S&P 500 PE against current earnings, and then the dark blue line is against future expected earnings, right? And what you'll see is there was a fall. They followed similar patterns as we came into 2000, and in the early part of the year, everything spiked. But there's a pretty big difference. If you're looking at current earnings right now, the S&P sits at about 28.6%, if I'm reading that properly, on existing earnings. The blue line, the light blue line, represents future earnings. So I said that in reverse. I apologize. And we're not going to edit that out, so you guys can figure that one out. The light blue line represents future earnings. So what you'll find here is if you're looking at the S&P 500 today and trying to compare it against existing earnings, the price earnings ratio at 28 is pretty high. It's elevated. If you adjust that for what's expected future earnings, that price earnings ratio comes down to under 23 times earnings. Maybe that's expensive, maybe it's not. But again, there's a difference in the lens and how you view it. And we do expect that we will see dramatic changes in earnings as we go forward. Many companies, especially in the middle part of last year, were very conservative in their estimates of earnings just because of the uncertainty. And we have seen many companies are beating estimates. And today, as we're sitting here on February 12th, we're in the middle of fourth quarter earnings, and many companies have been beating earnings on what was restated as we went through the pandemic. So as I said before, why did the stock market do so well? We've had all these things happen. Well, we've listed 5, right? Number one, and probably the most important thing that happened through this recession is really the first 2. It's supportive central bank policies and government stimulus programs. And there was a lot of it. And it wasn't just here in the United States, it was around the globe. Just to give you a little bit of an idea, back in 2008 and 9, the financial crisis, which was a very structural, long-term recession that we went through, the quantitative easing programs, which you've heard of and we've talked about before, they spanned over 3.5 years. The federal government in this go-around had passed the first CARES Act, had enacted a quantitative easing program that was unlimited within 2 weeks of our shutdown here in the United States. That was incredibly important and really, in our eyes, drove at least the immediate response out of the stock market and even the economic recovery that we started to see. The third column, which takes a little bit of explaining, is the big 5 and what we're calling disruptive companies. I'm going to get into that a little bit more in a minute. The stock market also doesn't look at today. So the stock market is always looking down the road at where are we headed. So again, a big reason why the stock market has been doing well is when that stimulus happened, the markets knew that impact would be positive, and the markets moved ahead of the economy. Excuse me. So what that means is, we know that the stock market is above where the economy is right now. We're going to have to continue to monitor that and see where it's going. And the 5th item here, which is really important, not only for the economy, but also for housing. We've seen housing go crazy across the country. Interest rates today are in the mid twos for conventional rates. This is helping fuel things. And if you think about this, if you're a retiree and your money's invested and you need to make 4 or 5% to live on, well, last year they took interest rates from roughly 2.5% to 0. What that means is that same equivalent investment on a safe, let's just call it a money market account, a year and a half ago could probably get 2%. Now those money markets are paying 0.5%. If you need that $4,000, if you have $100,000 invested and you have the same need, that doesn't work. So the other element that's happening right here is this interest rate environment is forcing more money to take more risk. More money is having to shift into the stock market and riskier assets to meet the same kind of expected return for investors. And that's definitely part of what we're going through right now. Before I move on, I want to touch on the big five. So the S&P 500, which everybody knows about, is the largest 500 companies in America. There's 5 companies in the top 500 last year that drove 25% of the performance. And what I mean by that is if you extract the top 5 companies, the best 5 performers for 2020 out of the S&P 500, on average, those 5 companies were up 65%. If you look at the other 495, companies for 2020 averaged 3%. So when we talk about this big 5 and how there was an unequal market movement last year, that's what we're talking about. 5 companies attributed to 25% of the return and averaged 60%. The other 495 companies only averaged 3.5%. It was a very unequal market that moved last year. Those disruptors, those companies that were in a position to take advantage of it, certainly did better. Interest rates. So we have a graph of interest rates, and everybody knows, today interest rates have never been lower. I feel like we've been talking about this for 10 or 15 years because we've had this screen and this slide up here before at our forecast halftime events looking at the bond market. What we have here is interest rates. So 10-year treasuries and the Moody's, and this tracks not the price of those bonds, but interest rates. The far left, we had a peak in interest rates in the high 90s. My dad still talks about it. Him and my mom bought their first home in 1978. The interest rate that they had was 13.5%. They had to put down 50% to buy that home. And it's hard for me to fathom. I bought my first home. My wife and I bought our first home in 2000. The interest rate was roughly 4.5%. I had to put 5% down. This interest rate environment that we've been in is just incredibly low, and it's gotten lower. And so the question here is, at some point when interest rates go the other direction, the price of bonds and interest rates are inversely related, meaning as interest rates go down, the price of that existing bond goes up. The opposite is also true. When interest rates start to go up, the price of that bond will go down. This is something we've been worried about for a couple of years. And even prior to pandemic, we started to shorten the duration of our bond to protect ourselves. And what happened last year is because of the pandemic, the Federal Reserve took interest rates to 0. And they've been very clear that they intend to keep interest rates at 0. So one of the things that we are less concerned about now, at least where we are today, is interest rates. We don't think that we're going to have to worry much about interest rates moving. I mean, they'll move up and down just based on demand and kind of what the markets do. But we don't think that the Federal Reserve will be raising interest rates for an extended period of time. But if you are carrying debt, or if you're looking at borrowing, this is an opportunity that you need to look at. 30-year fixed mortgages are hovering in the 2.5% range. Some are lower, some are a bit higher. But this is a piece that we're trying to talk to all of our clients about, which is if you are carrying long-term debt, in particular mortgage debt, if you haven't considered this. And I had a client that I talked to the other day said, well, geez, I just refinanced a year and a half ago. I don't think I need to worry about it. I said, well, send me your statement. He sent me his mortgage statement. He had a 4.5% 30-year fix, and he had just refinanced a year and a half ago. So if you haven't taken a look at that, please do. If you need help, let us know. We have professionals here to help you through that. Inflation. So inflation and interest rates go hand in hand. We expect that we will see inflation at some point with all the government spending that's happening. But as of right now, inflation is virtually non-existent. What we have on the slide here is we have inflation broken down in a couple sectors. The red on the far left is kind of all items out there, and there is some inflation. Food, which is the blue line, has had the highest inflationary figures. You can see that was roughly 3% last year. Energy inflation went down almost 10. On almost 10% down, and then everything else, less food and energy, you can see there was a little bit of inflation. So in general, the Federal Reserve is not concerned about inflation right now, but we know at some point when that does come back, the Federal Reserve's tool to fight against inflation is interest rates. So we know that at some point that's going to happen. We found a quote out of The Economist back in December of 2020. Some of today's inflationists predict a possibly high but transitory spike in prices as consumer spending bounces back from the pandemic. Economists at Morgan Stanley predict a fundamental shift in inflation dynamics in America, with inflation rising to the Fed's 2% target by the second half of 2021 and going to overshoot it. So essentially they're saying we're going to see inflation come back in the back half of this year, and it'll probably continue. Again, we're in an environment right now where inflation isn't having much of an impact with the exception of food, which, again, even when you think about economically, unfortunately, what we've seen in the pandemic is it's hurting some portions of our population much more than others. And unfortunately, they're the people that need it the most that are being hurt the most right now. And that's something we're going to have to continue to watch. Now, there's two things my mom always told me we're never supposed to talk about in public. The first one, and you're probably saying it right now, is religion. The second one is politics. And we're not going to get into politics. And it's a very politically loaded subject and has been for several months. But here's what we wanted to point out. In the statement of keeping politics out of your portfolio doesn't mean that we don't pay attention to policy, that we don't pay attention to things that are changing, because we do. But this goes back, we went all the way back to the Truman era. And if you look at this slide, what we did is color-coded it for who is in power, Republican or Democrat, and how the markets performed. And the bottom line is what history has shown over and over again is there's no correlation. It didn't really matter. Policy may matter, things like that may matter. So again, we're not saying that we're ignoring this, but what we don't want our clients to be doing is making changes to their portfolio because their belief falls one way or the other. We are focusing on policy and what the impact of the economy might be, and that's where we're going to focus our attention as we move forward there. So that was a lot about where we've been. We've had a lot to cover in 2021, and I know I'm going super fast, but it was an exciting year. I wish it didn't happen, but we had a lot going on. And so where does that take us to now, right? When we think about, okay, well, we've been through this year. Now here we are. Where are we right now? Well, first and foremost, we're still working from home for the most part. Our kids across the country, the vast majority of kids are still learning at home. Not everywhere, but in a lot of different places. Even though economically things are coming back, there's still a lot of things the same, right? And we're coping. As Americans, and I think the world has been amazingly resilient at shifting on the dime from a way of life we had to where we are now and how we've been surviving and getting through here. And there has been a lot of good that's happened from it. Here's an interesting report, and this is an investor sentiment survey that was done at the end of last year. And not to say that, but ultimately what they found through this survey was that 49.1% of people were bullish on the stock market and the economy. And the general thought, you can read it here by Robert Schiller, with interest rates low and likely to stay there, equities will continue to look attractive, particularly when compared to bonds. I mentioned this earlier. If you're a retiree needing 4 or 5% to live on, and maybe you could used to do that with bonds, and all of a sudden bond rates went to zero, it's forcing people to take more risk. And so we do think that you'll continue to see that, but it also presents a different kind of risk on the other side that we're going to have to take an air on. This poll was a little bit different, though. So this was a national poll of CFOs, chief financial officers from around the country, done just a couple of days before ordinary investors, and 80% of CFOs surveyed said that they thought the S&P 500 was overvalued, meaning the markets were too high. Again, two very different people. These people are running companies. I will say that CFOs don't tend to be the best investors. Maybe not quite as bad as doctors. I apologize if any of you are doctors on the line, and I'm just having fun. But two different perspectives on where we are in the valuations. This was a really great article that we found from Liz Ann Saunders and from Schwab back in November, and we do agree with this. If vaccines represent the light at the end of the tunnel, the virus means we are still in a fairly dark part of the tunnel. Now, again, this was back in November, but that continued. That dark tunnel continued through December and actually worsened as we got into January. For all of you that are watching that live here in Arizona And even for those who weren't, we were one of the worst states in the country for COVID spikes, even just a few weeks ago. It does seem like we've turned that corner and things have started to come down. So that light, that vaccine, and again, that announcement of the vaccines and really what we're starting to see now with the vaccine rollout is that light at the end of the tunnel. What it also did, the knowledge that these vaccines were coming, even though there's a lot of uncertainty, it did start to spark some market rotations, and we've highlighted a few of them. We saw a rotation from growth to value. We saw a rotation from large cap to small cap, from defensive to cyclicals. What we're hoping for is stay at home to out and about and leaders to laggards. Now, so we wanted to illustrate this in this way so you could see it's very difficult to time that. I think part of what's important of what we tried to do when we are analyzing our clients' life savings is be well diversified, right? If you happen to bet wrong early in the year and had too much in one sector, you might have been paying the price, or it might have done well. Our objective is to stay well diversified so we don't have to try to time when is this going to change. We know that that's not possible long term. But we do have rough roads to get to where we're going. So even though we have this vaccine rollout, these are some of the major issues, and we're seeing this first one right now, which starts with the vaccine delivery and the challenges that may be presented there. And I can't tell you how many conversations I have day over day with people that are trying to get the vaccine that can't. But we have other issues. We have long-term unemployment. What's going to happen with all these small businesses that can't survive? We're looking at another economic relief plan right now. And what about economic safety plans like unemployment or just COVID checks that have been coming? These are all issues that we have to get through. One bright spot, and I touched on this earlier, the generosity of the United States is amazing. I'm going to jump to another survey, but year over year for the first half of 2020, in spite of all these challenges, in spite of unemployment spiking, nationally, the charitable giving in the United States rose by 7.5% in the first half of the year, which is incredible. Donor advised funds grew 46%, last year through this pandemic. So there are some shining stars, and as a country and as people, I do find that that's amazing. And I'm proud to be a small part of that in the efforts that we're doing here in our community. So in our final steps here in the next 5 or 10 minutes, as we talk about where we might be going, we've covered a lot about where we were. We've talked a lot about some of the initial or the things that we're looking at right now. Well, here's one of them. How about revaluing our time? One of the things that I'm hearing over and over again, especially from my clients that are at late stages of their career, is this reevaluating their time. Where do you want to spend your time? Are you going to retire early? Are you going to continue to work? These are things that many people have been forced to reconsider as we've been forced away from our families, not able to travel to go see our kids and grandkids and family members on other parts of the country. How much is your free time worth? The U.S. Department of Transportation estimated in 2016 that the average working person's hours were $13.60. The University of Chicago just did a recent report at the end of last year, said $19 an hour. How will this impact the workforce? Will we see more people start to retire? Will we see partial employment? Maybe we'll see more business creation. We might see a whole round of people that became unemployed who might go into those restaurants and start new businesses on the other end of this and take advantage of it. There's a lot ahead. And we've listed, again, you'll find this 5 things up here that we've kind of stuck with that theme. Working from home, the housing boom in the housing market has just been crazy. I don't know that it's sustainable long term, but we're in the middle of an amazing housing boom. Americans are saving more than ever. Savings rates have spiked to historical rates. And I hear a lot of this from many of you when I talk to you. Well, we can't do anything anyways. So we might as well keep the money in the investments or put it in our home. Sustained innovation. If there's one thing we all know, technology advancements were forced to happen this year. We weren't doing events like this behind a camera a year ago. We were inviting you out to have cocktails at a hotel across the street and see each other. Will that come back? How quickly will that come back? Demand for cleaner energy and a pursuit for social justice, just to name a few of what we believe will be on the outlook for 2021. Economic outlook, again, 2021, looking at estimates for GDP growth. You can see what's estimated around the world on the slide here ahead of you. What is estimated for the United States is about 3.1% growth in 2021. Will that happen? Will the pace be continual? Will it be stalled? Again, so much of this we believe depends on the vaccine rollout and getting to a herd immunity and or to a place where we can see the economy reopen and stay reopened consistently. This was a really great quote that we found from Morgan Stanley. World economies rarely move in lockstep. In fact, usually it's very, in fact, the opposite. What's different about this is this pandemic have forced this to happen in a negative way. Last year was around the globe. Every country was impacted. Every country took different measures to protect themselves. But on the other end of this, as we see recovery out of it, it's the same impact. Everybody's going to be coming in recovery. And the bottom half of this, my favorite part of this, the stage could be set for another such sync beginning in the second quarter of 2021. As the world starts to reopen, will there be pent-up demand? Will we see economic growth accelerate as we make up for things we weren't able to do for the last 18 months? This is an important thing that we're going to be watching. Free trade agreements are incredibly important. This is another area that we're going to be watching. I'm not going to get into it in much detail because it does get complicated. But we've got 5 risks here that we think are key to watch. And these will be the things that we kind of want to leave you with in an effort to say these are the most important things. Number one, the vaccine effectiveness, right? We're seeing the rollout happen. Just last night, it was announced in Arizona that 1 million people have been vaccinated here in Arizona. Will they work? Will we continue to see that rollout happen in a predictable and fast way? And ultimately, will that lead to a reopening, and how quickly? That will drive what we believe will be the pace of the recovery. Will there be pent-up demand? Will people be willing to jump on an airplane or go back onto a cruise ship? Or will people slowly enter back into that? U.S.-China tensions are important. Consumer habits and investor behavior, which are 2 things that are still unknown. Will consumers continue to shop online, or when malls reopen, will consumers want to go back into a mall to try a pair of shoes on versus just ordering it? And the same with investor behavior. We've seen a lot of crazy action this year in 2021 with the Reddit trade and all these different things that are occurring. Will we see that slow down a bit, or will we see these erratic behaviors continue? We have, debt. Again, this is something that we've talked about for years. We used to have a debt clock that we would have when you walk into the room that would show the national deficit and how quickly it's growing. This event, the pandemic, has accelerated that. The government has taken extraordinary measures to push stimulus in the form of more debt into the economy. And again, we're in the middle of Congress debating another package right now that might be as high as $1.8 trillion. So as you can see there at the far right end of your screen, that debt level is going to continue to grow. How will that be managed is going to be an important thing to continue to watch. And again, this was just a quote talking about that debt. Wait a minute, what about all this debt? What are we going to do now? At some point after we get through a reopening, this debt has got to be paid back. And that's a concern that we're going to have to watch and continue to monitor. Something that we haven't had to talk about in the last few years, but we do think it's going to become more important, is legacy planning. There was a handful of tax and legal changes last year that do change things. The Secure Act changes the way that people can inherit qualified accounts or IRAs. And many of you, we've been talking with you about this. If we haven't, or if this is something that you'd like more information, please contact your advisor, contact us, and we'll set up time to talk to you. We know tax changes and tax policy are coming. We just don't know what. And again, COVID-19 continues. We're still in the middle of this pandemic and trying to see how it plays out. So this is the fun part where we get to ask the experts. So we pulled a few of the same experts that we normally pull. First one is Stanley Duncan-Miller, who is an investor and philanthropist. He's on CNBC very frequently. So here's when asked, what do you think about the stock market in 2021? Stanley's answer: I have no clue where the market is going in the near term. I don't know whether it's going to go up 10. I don't know whether it's going to go down 10. But I would say the next 3 to 5 years are going to be very, very challenging. That's Stanley's opinion. The Economist, which this article was found in November 28th, COVID-19 has brought with it economic damage on a vast scale. Yet the rapid changes that have been forced on many industries are leading to innovation that will outlive the pandemic, and in some cases are leaving incumbents less mighty than before. Essentially talking about the new innovations that have occurred. Maybe that will drive the markets to higher levels. Stephanie Kelton from the Economic and Public Policy of Barron's: how we work is definitely changing. That could have long-term disruptive effects to air travel, commercial real estate, downtown restaurants and such. We also know we're going to lose potentially half of all small businesses, which is incredible. That's going to have a big impact on the economy and the makeup of our local communities. Climate is going to be a huge in terms of investment. Private sector, we're seeing this now in what's happening. Clean energy, we know is going to be a focus. How will that change and push the economy? Whenever the market is trading at or near an all-time high, and I like this quote, it's important to assess the risks. Sentiment remains a key risk, especially given the economy remains inside the tunnel. Even if vaccines represent the light at the end of the tunnel, investors should remain disciplined, diversified, and opportunistic with regarding to rebalancing. Right? I think this is the most important thing. As a firm, we are relatively conservative. And here's a different way of thinking about this. You might be driving safely, right? As you drive home tonight or wherever you are, you might be a safe driver, driving in the speed limit, have your seatbelt on, driving, within the lines. But when everybody else is driving erratically, even though you're staying safe, the risk goes up. Think about being on the Autobahn. You pull your car onto the Autobahn and you're going 65 miles an hour and zoom, zoom, zoom. You've got cars passing you at 125 miles an hour. Even though you haven't changed your style or how you're driving, the risk is heightened for you. And that's important to consider right now when you think about this whole thing. A lot of people are saying, well, we're going to stay the course. I think what we have to start to be able to do, though, is realize that as these markets push higher, and maybe not today, but as we recover out of this pandemic and the economy reopens, we may need to pull off the Autobahn. And that doesn't mean get out of markets. It doesn't mean go to cash. But we need to think about that. And somebody else told me that analogy, and I thought it made a lot of sense, that even though your driving behaviors haven't changed, how other drivers are driving around you impacts the risk to you. And I think as the markets advance, we need to be thoughtful of that and thinking about how can we do that. We've integrated a tool called Riskalyze, which we did about 2.5 years ago, specifically for this reason, to help us better analyze the risk that you're taking and assess and find ways to reduce that risk. And the goal would be to compromise return as little as possible. This is going to be a focus that we have as we move forward. Thank you so much for your attention tonight. I hope that you've learned or enjoyed the presentation, found some tidbits to take away. I'm so proud of the team of people that work and support us and you every day. I want to say thank you to you as well. We've had the great fortune of being blessed with serving a lot of amazing clients and people like you who continue to reward us by referring your friends and family. And our commitment is we're going to continue to improve and do the best we can as we move through this path. I hope you've enjoyed this presentation for the forecast of 2020. I really look forward to doing this again in person, so we look forward to that day. But until then, be safe, be happy, and we will talk to you soon. Thank you so much.